This is not going to be a heavily edited video like I typically have.
Vietnam, great negotiators, great people. They like me, I like them. The problem is they charge us 90%. We're going to charge them 46% tariff.
Many of you may not be aware of this, but I used to be an executive working in supply chain, and I also worked for some very large retailers. And I happen to have a perspective on timing and the impact from tariffs that you may want to consider. First off, I get it. There's a lot of uncertainty even with what has just been announced. But let's try to map out what's happening, what could happen, and how we prepare our investments to make the most money moving forward. I think it's ideal to mention the strategy behind the tariffs, where we have really just two camps of thought, where the first one is that we need equitable free trade among all countries.
Either the rest of the world agree to a fairer trading system, and these are short-term tariffs.
And they agree how quickly?
Hopefully quickly.
Well, what does that mean, quickly? Like a week or a month or 6 months?
It'll take a few weeks.
And the next form of thought is that the strategy is not really mapped out very well.
We don't know the who, we don't know the what, we don't know the where, we don't know the when, we don't know the why. Other than that, clear as day.
At this point, I think that everyone understands how tariffs work. But in order to explain it further, I completely geeked out and I created a video game for my kids to show sort of how escalating tariffs are a game without any real winners. But hey, look at inflation. That seems to be getting a lot out of it. So here we are. The day has come where the tariffs are a reality, and we're all observing how the markets are reacting. This is now our current situation for the foreseeable future. I see us as having three different paths ahead of us, and we need to be prepared with our investments. The first is short-term resolution, in that we have these tariffs in place for the next 6 to 8 weeks until all countries work out a fair trade solution. And the second is escalation, and that these tariffs escalate and our pain gets worse with each volley back and forth, and that could go on for multiple months. And the third is a quick reversal, where the US drops the tariffs within a couple of weeks because it's just causing too much strain on the economy. In the first scenario, if all the countries find a solution within 8 to 10 weeks, then the moment that's announced, we will see massive spikes in the markets, and people will begin to reinvest in the stock market at record levels. I'd rather have my money already in the market before everyone else hears the good news, because as I've mentioned, some of the best days in the market happen during the bad times or right after some of the worst days. I simply don't think this is an item or an area that anyone can time perfectly. In the second scenario, where these tariffs volley back and forth and escalate like that Pong-like game that I had created, I just had to show it once again since I built it just for this video. This option would be catastrophic, and would probably drive us into a recession. Now, I want to map this out for you as to what this might look like. So far, growth stocks in the tech sector have felt the drop more than any other area. Tech is always that tip of the spear when it comes to sentiment and fear. And that's okay, it's expected. A lot of investors pulled out of the tech sector and they've increased their cash holdings. Or surprisingly enough, there's been a massive influx in actively managed ETFs.
Active ETFs, assets under management, surpassed $1 trillion for the first time ever. It's now almost 10% of ETF assets.
The speculation is that people are more confident in someone else managing their investments during difficult times, which are going to be over and above an index. Even though it's been statistically proven that an index fund tends to outperform the majority of all managed funds. In either case, in the short term, tech stocks were hit the hardest. And with tariffs being implemented, I expect that retailers and manufacturers will see a major spike in sales where consumers want to get ahead of the cost increases. And I'm going to warn you, this will be a false positive in the news cycle. Get ready to ignore it already. For most all areas of manufacturers and retailers, they only have 2 to 4 weeks of cover or safety stock. This is extra inventory that they've set aside to weather high spikes in demand. Granted, on perishable items with short shelf lives, like an avocado, it would be seen within about 2 weeks. Regardless, this means that the next 2 reports on inflation data won't be showing the full impact of tariffs on the CPI report. If we continue on this path, then expect July and August to be one of the larger pullbacks in the stock market, because the inflation data will be a major shock to the system. In addition to this, All quarterly reports happening between now and July will show companies bringing down their guidance for the rest of the year, and this may cause a little bit more pain for all of us investors. But please keep in mind, this is just one potential outcome. Now, there is this concern that I have for a lot of investors. Several people have pulled their investments from growth companies, and they're holding a lot of cash. Or maybe they shifted over and invested into blue chip stocks with strong dividends, and there's nothing wrong with that. But if tariffs drag out for months, then all these evergreen stocks with dividends, well, they're going to get hit hard when the inflation data and the future guidance is brought down. That means that some people may have been hit hard when tech stocks went down, and then they're going to get hit again from moving to blue chips that get knocked down in a few months from all that's happening now. Just be cautious and pay attention to how the CPI data and the future outlook may impact your portfolio. But once again, this is if tariffs drag on for a long time. We could also have the third outcome, where the US drops the push for tariffs within just a few weeks. But I don't see this happening since we won't even see the full impact on costs for the first 6 weeks that tariffs are actively enforced. There are no incentives in the short term to make a change because we won't see the full picture. And this is just another false positive that you need to be on the lookout for. Don't assume that prices and inflation reports looking good for the next 2 months is reality, because it won't be. On top of all this, we have the auto tariffs that are kicking in tomorrow. But I saw a very good report on this that you may want to see just how much of your car brands are truly domestic.
You're probably wondering who is most hit by this. And what we can do is we can draw up a list of the companies from the most vulnerable. And the most vulnerable are the companies that aren't making as many, that a smaller proportion of their cars is actually made in America, to the least vulnerable. So the higher this line is, and the red one there is the least vulnerable. Who do you think is the least vulnerable of all the car manufacturers? Guess what? It's Elon Musk's company. Coincidence or not? You be the judge.
Now, the overall theme is that all vehicles are about to get a lot more expensive. And I do mean all vehicles. Even our US branded companies have a lot of vehicles and parts that are made outside of the US. And that desire to have manufacturing brought back into the US, I don't think it's a very realistic argument in the short term. Because to build a plant like that would take 4 to 5 years under the best conditions. And with markets going down, these car companies have lost equity in their stock in order to raise funding for those large CapEx investments. It's kind of a double negative. But for argument's sake, let's say that we do bring back all the manufacturing plants back to the US. The reality is we don't have the labor force to support all that shifting of jobs, which means that the salaries will need to be at a premium. And then a lot of companies outside of the auto industry will also have to offer a premium salary to fight for that same labor pool. This, in turn, will cause our inflation to go up even further. Those are a few potential outcomes, but how do we plan around it? First off, everyone is at a different stage of their investment life cycle. If I were 60 years or older, I'd have more fixed income assets and enough funding outside of the market to weather a recession that would last at least a year. And no, this is not me giving any advice. It's just me thinking how I would handle the situation if I happened to be in that age bracket. And of course, I do need to bring up this chart once again to showcase that over a 19-year time period, if you miss the top 10 investing days that happened to be in a bear market, then your return would be half of what it would be if you just left it alone.
If you bought the S&P 500, just the S&P 500 in October of 2007, probably the worst time you could think of going into the great financial crisis. And if you held it through that and came out the other side and held it through everything, peripheral debt crisis, Fukushima, COVID, you'd have a 9.5% annualized return through to the current date. I mean, look, if you want to say that by market timing you can do better, that's great. But most people who market time do worse than that.
For everyone else, my point of view is that this time period is where I happen to be doubling down on my dollar cost averaging on my investments. And yes, the markets will probably go down further over the next 3 months if we continue on the same path with tariffs. And I think I mapped it out pretty well. But what if the tariffs, just what if, they're successful in leveling the playing field for equitable trade? If that happens, then not only would we see a major spike in the markets from tariffs going away, but the potential for US companies to export more fairly would be a huge windfall, which would result in a major rally. Now, I get it. things seem very hectic and chaotic at the moment, and that's just noise. You need to see the path ahead and stick with what you already know. Even though we may be in a drought for the next several months with little or no growth for the year, this is the time where I doubled down on investing when everyone else is scared. I also need to bring up the momentum or the tailwinds that are expected for the second half of the year. Regardless of tariffs, we have the Fed that's looking to reduce the rates 2 to 3 times later this year. And the current administration will also look to have reduced regulation and improved tax advantages for larger companies that should come to light in the second half.
And some of the more pro-business aspects of the new tax cuts could, create that sentiment impulse that we're looking for to drive gains in the second half of the year.
So I do want to shine the light that there are a few positives that are going to help out that hasn't really been accounted for. But if we can have a solution to tariffs, a reduction in rates, and reduced regulations on companies, then it has a potential for an incredible second half. But we all need to have our seeds planted well before the rain and the sunshine come out. Continue researching companies in robotics, AI, quantum computing, and energy production to continue sharing on the channel. And when everyone is ready to reinvest their money back in the markets, they'll want to get back into the Meg 7, for sure. And they'll want to get in as early as possible into those new areas of innovation. With regards to tariffs, hopefully I've covered the most realistic outcomes ahead of us and how we can work with it. And whenever we get new information, I accept it for what it is, and I change my plans accordingly. That's the fun part about investing. The information and the dynamics are constantly changing, and we need to be willing to learn and take in new information. And I hope that I can share some of that new information with you as all of this unravels. Please try not to get too stressed out with all the news, and let's navigate this together. And as always, thanks again for watching.